In today's episode, I'll talk about three very interesting stories. In the first story, I'll talk about how the Reserve Bank of India, or the RBI, has very quietly shifted about 102 tons of gold from overseas vaults in London to India. In the second story, I'll talk about how oil prices are constantly rising across the world due to geopolitical tensions. And in the third story, we'll analyze the latest quarterly results of Motilal Oswal and understand what are the insights and learnings that we as investors can take away from it. Welcome to the Daily Brief Show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that is easy to understand, yet one level deeper as compared to traditional news channels. I'm your host Anurag Bansal, and today is Tuesday, the 5th of October. If you have knowledge or experience in any field related to finance or economics and you would like to share it with other people, we at Markets by Zerodha would really love for you to do so. Please get in touch with us using the email ID markets@zerodha.com and we'd love to have a chat with you and figure something out. Let's begin with the first story. The Reserve Bank of India has very quietly shifted a massive load of gold of about 102 tons to India from overseas vaults in London. Now this is a lot of gold, not just physically but also in terms of national importance. To put this into some perspective for you, this is roughly the weight of about 17 African elephants or about 20,000 gold bars. And this move by RBI is not just about moving gold closer to home, it seems to be a strategic decision that is aimed at securing our nation's wealth within our own borders. Now, as of now, India holds a total of 855 tons of gold in its reserves. Now, 510 tons out of this gold is stored in domestic vaults. The rest for the time being remains in the Bank of England in London and with the Bank of International Settlements in Switzerland. Now the question here is, why does RBI really care about where gold is stored and what does this recent move mean? Let me break this down for all of y'all in this story. See, for central banks across the world, gold is somewhat like an insurance policy against geopolitical risks, inflation, etc. Since central banks hold gold in physical form, it makes gold not subject to being frozen or seized by foreign governments or financial institutions. Now, unlike digital reserves which are held in other countries which could potentially be blocked or restricted, physical gold is fully under the control of the country that owns it. And that is why big countries like US, Germany and China, and even international bodies like the IMF or the International Monetary Fund hold large amounts of gold. In fact, the US leads the pack here with a massive store of 8,000 tons of gold. Now, in comparison, India's 855 tons of gold might seem a little small. But this latest move by RBI shows that it is not just about quantity, it also has a lot to do with where this gold is being stored. Bringing a significant portion of gold back home seems to be a step towards safeguarding these assets from potential international risks. Now, at this point, I'm sure you're wondering, if there was a risk in the first place, why did India keep its gold in London for so long? Look, to understand that, we'll need to take a short look at some history. In 1991, India faced a severe economic crisis, which was known as the balance of payments crisis. The situation was so bad here that the government needed to pledge some of its gold in order to secure a $405 million loan from the Bank of England. Even though India eventually bought back that gold, a portion of it remained in London for logistical reasons. This left India aware of the challenges and the risks of storing its national wealth in overseas countries. For years after 1991, the RBI continued to store a significant part of its gold in London's Bank of England vaults. And this is because London is the heart of the global gold market. It is known for its liquidity, transparency, and security. With the London Bullion Market Association setting standards, having gold in London pretty much means quick access for trading or other arrangements like currency swaps. Essentially, London has been a very strategic location, so to speak, for central banks worldwide to store golds and allows them to manage their reserves with minimal hassle. But the thing here is, times have changed now. Today, the global financial landscape is experiencing some serious shifts. This is driven by rising geopolitical tensions to a great degree. Recently, in response to Russia's invasion of Ukraine, Western countries led by US and Europe froze about $300 billion of Russian central bank reserves. Now the scare here is, what if something similar happened to our assets that are stored abroad? See, historically, even though London and Switzerland have been safe havens for gold storage, this asset freeze highlighted the risk involved in keeping wealth in foreign jurisdictions. And India's recent decision to bring home more of its gold showcases exactly this concern. By doing so, the RBI is acting very cautiously and is reducing its dependence on foreign storage and insulating India's wealth from potential geopolitical pressures. Now let's move on to the second story of the day and talk about crude oil. Now this I know is a topic that keeps coming up on this daily brief show, but there is a reason for it. The reason is because India very heavily relies on imported oil. About 80 to 90% of the oil for our needs are imported from other countries, to give you a perspective. So as a natural result of it, it hits us very hard whenever oil prices rise globally. From how much we spend on fuel to the broader health of our economy, all of it gets impacted. Now, oil prices have recently been a big topic of concern because of the ongoing geopolitical tensions in the Middle East. And that is where the global politics and oil dynamics come into play, which is very important for us as investors and also people who track the markets to understand. Look, there's an alliance of oil producing countries called the OPEC Plus, which holds significant control over oil supply. It includes 13 members of the OPEC, which stands for Organization of the Petroleum Exporting Countries, plus an additional 10 countries, including the likes of some of the world's biggest oil exporters like Russia. Starting in late 2022, this group began cutting oil production, which means that they decided to produce less oil every single day. This was done in order to keep prices from falling too low by controlling how much oil is available in the market in the first place. From 2022 to 2023, these cuts added up 5.86 million barrels of oil per day, which is close to 6% of oil demand. To put it simply, this is a massive reduction in oil supply, and it is big enough to affect prices worldwide. Now, very recently, a major update came in from OPEC+. Over the weekend, 8 countries in this group announced that they are changing their strategy. Initially, they had intended to reduce their supply cuts and had planned to release an additional 2.2 million barrels into the market next month. But now they have decided to delay this move. This means oil supply will remain tighter than what was originally anticipated. ING's analysts say that there are several reasons for this delay. Saudi Arabia, for instance, is concerned that easing the cuts could lead to a loss of market share to other producers. Additionally, there are worries that some countries are not quite fully sticking to their quotas, which simply means that they may not be cutting production as much as everyone initially had agreed. But here is where things get a little more puzzling. See, despite these production cuts, oil prices have not quite surged as much. Brent crude, which is a major benchmark for global oil prices, is currently trading at around $74 to $75 per barrel. That is about 10% lower than its peak for the month of October. So then this brings us to the question, why aren't oil prices rising despite the cuts and the tension in the Middle East? See, a few factors are keeping prices down, and I'll explain them to you very quickly. First is the global economic slowdown. See, economic growth, especially in big markets like China and Europe, has been much weaker than was expected. A slower economy means lower demand for oil because factories produce less and people and goods also move around less. The second is high oil production in the US. See, the US has been pumping oil at record levels. They are adding more supply to the global market, and that is helping keep prices in check. The third one is high interest rates. High interest rates, particularly in the US, tend to slow down economic growth. This slowdown means that businesses as well as consumers use less oil, and this softens demand. Fourth, Russia's steady production. See, despite facing economic sanctions due to geopolitical tensions, Russia has managed to keep its oil production as well as exports fairly steady. This has added to the global supply. Demand for oil is also showing some signs of weakness, especially in Asia, which is one of the world's largest oil consumers. To give you an instance, Asia's crude oil imports were lower in October as compared to the month of September. But despite all of these reasons, one of the main factors here is China. As a major driver of global oil demand, China has contributed to over 60% of the growth in global demand for the past decade or so. In response, the International Energy Agency, or the IEA, has lowered its forecast for the global oil demand growth in 2024. So with all of these factors in the picture, there are two very different directions oil prices could take in the coming few months. Let's talk about the bullish case first. See, tensions in the Middle East could escalate and potentially disrupt oil supplies. For example, if Iran retaliated against recent regional events, it could very badly impact vital oil supply routes. A similar situation had occurred in 2019 when attacks on a major Saudi oil facility took out about 5 million barrels of production in one single day. Such disruptions could lead to sharp increases in oil prices. Then there's the second bearish case. See, analysts are forecasting that by 2025, the oil market could have an oversupply of about 800,000 barrels per day. This surplus would primarily come from increased production in non-OPEC countries like the US, Brazil, Guyana, and Canada. If China's demand stays weak and OPEC Plus completely reverses its supply cuts by 2025, Brent crude prices could fall into the low $60 per barrel. In the event of a recession, prices might drop even lower to $50 per barrel. Now, with that said, there's another small layer to this already complex picture, which is the upcoming US presidential elections. Now, there are two scenarios here. First, if Trump wins. Second, if Kamala Harris wins. Let's talk about Trump first. See, in this case, Trump has indicated that he would apply maximum pressure on Iran, which will likely reduce the Iranian oil supply. He's also committed to ramping up US oil production by streamlining permits for drilling and pipeline projects. But in the second outcome, if Kamala Harris wins, we can expect her to continue the current administration's approach. This balances managing the oil supply with reducing emissions. This would mean maintaining sanction policies while focusing on environmental goals. But that said, let's get to the most important question now, which is what does all of this mean to people like you and me? Look, in the short term, oil prices are likely to remain unpredictable. There are swings based on both economic and geopolitical factors. For India, this uncertainty is particularly very important. If oil prices spike, our import costs will rise and it could impact the economy in multiple ways. On the other hand, if prices drop due to an oversupply or a weaker demand, we may see some relief at the fuel pump. But ultimately, all that said and done, keeping an eye on these factors will be very crucial to understanding where oil prices and also our economy might be headed. With that, let's move on to the last story of the day and talk about a bit of a tussle in India's financial markets. See, today on one side, we have a very strong domestic momentum with many Indians investing steadily. But on the other side, there are some global uncertainties and some very lofty stock valuations that seem to be pulling the market down. In this story, let's break down what is exactly happening here, beginning with the big picture and then diving into the details. Let's start with what the big news is first. See, it's no surprise that India's stock markets have had an exciting year this time. The Nifty and Sensex, which are the two main stock indices, have hit record highs in September, which showcases just how much confidence there has been in Indian companies and the broader economy as well. Now, this rise has largely been powered by Indian retail investors, which is everyday people like you and I buying shares, not just big institutions. Domestic institutional investors like mutual funds have also played a big part here. They have stepped up even as foreign investors have been more cautious and have pulled back. But today, there is a growing sense of nervousness out here. A mix of global issues and high stock prices is making investors a little more hesitant. Events like the Israel-Iran conflict, upcoming elections in the US, a stronger dollar, and rising US bond yields are all adding layers of uncertainty. The market, it seems, is feeling the weight of these global concerns, so to speak. As we stand right now, we are also deep into the earnings season, which is a time where companies report how much they have earned or lost in the last quarter. And the news here has been a little underwhelming, so to speak. If you look at the results of the September quarter, it looks like we've had yet another weak period of corporate profitability in India. Nifty 50 has slipped about 10% from its peak. This dip is a reflection of how the market is digesting these disappointing earnings. Most large companies have shared their numbers, and a gist is that corporate revenues grew by only 8% compared to last year and made the sixth quarter of single-digit revenue growth. But profits actually dropped by 3.5% year-on-year and marked the first decline since quarter 3 of the last fiscal year. Now, for those of you who follow the markets closely, this profit drop has raised some eyebrows. According to some analysts, over 65% of companies in the NSE 100 index have already reported their earnings, with about 48% missing expectations by over 4%. This is the highest rate of earning misses since the early days of the pandemic in March 2020. Now, Motilal Oswal, which is a very well-known financial services firm, recently shared their expectations for this earnings season, and it's a bit of a mixed bag. For the quarter ending in September, they project that Nifty earnings will grow by just 2% as compared to last year, which is the slowest growth rate since mid-2020. If we exclude oil marketing companies, this growth nudges up to around 5%, which is still fairly modest. While earnings are growing, they are doing so at a much slower pace than investors would like. So then the next question is, are there some sectors which are doing better than the others? Yes. See, there are some sectors that are expected to perform well. First is banking and financial services, or BFSI. See, the finance sector, especially banks and lending-focused non-banking financial companies, is expected to be a standout this quarter. According to Motilal Oswal, they are predicting an 11% year-over-year earnings growth for this sector, with public sector banks leading the way at about 17% growth and private banks seeing a more modest 5% growth. This optimism stems from stable credit conditions, meaning that the financial environment is supportive of lending, which is great news for banks. The second is healthcare. Look, healthcare companies, thanks to a strong domestic demand and strategic product launches in the US, are set to grow by 15% in earnings. Hospitals in particular are benefiting from more patients and better efficiency, which helps their profitability to a great extent. Third is utilities. Companies in the utility sectors, which provide essential services like electricity, etc., are expected to see a 24% rise in earnings. New infrastructure like added capacity for power generation and increased demand from both industrial and urban areas are driving this growth largely. Now, major players here are NTPC and Power Grid, both looking greatly to benefit from these favorable conditions. But then, like I said, there are also sectors that are facing some challenges. The first one I'll talk about is metals. See, while metals have enjoyed a very strong performance last year, growth here is expected to be flat at only about 2% increase year on year. Lower prices and great amount of competition from countries like China are putting a lot of pressure on this sector. The second one is oil and gas. This sector is in for a tough time with profits expected to fall by 33% compared to last year. Weak global oil prices and low margins for refineries are squeezing profitability over here. Major companies like Reliance and BPCL are likely to feel the pinch as they face lower revenues and tighter profit margins. The next one I'll talk about is cements. See, cement companies are expected to see an even steeper earnings decline of 41% compared to last year. Oversupply, pricing pressure, and high input costs are squeezing profit margins to quite a great degree. This highlights the challenges commodity-driven industries like cement are facing, while rising costs and falling prices make growth a very difficult task. But overall speaking, Motilal Oswal's market outlook is cautiously optimistic. On the positive side, strong domestic inflows and hints of a rural consumption recovery offer some level of stability. But on the concern side, the Nifty is currently trading at about 21.5 times its forward earnings, which is about 5% above the long-term average. Additionally, the market cap to GDP ratio is sitting at 146%, which is much higher than the historical average of just 85%. High valuations like these can lead to volatility, especially if companies do not deliver on high expectations. The situation is even more stretched in the broader market, with mid-cap and small-cap stocks outperforming the large caps. The Nifty Mid-Cap 100 is up 48% and the Nifty Small-Cap 100 has climbed up 50%, which has pushed their valuations to a 60% premium over Nifty 50. Now, while these stocks offer some growth potential, high valuations means that they are also much more riskier. Another factor here is the role of interest rates and retail investors. See, globally, central banks, including the US Federal Reserves, are moving towards easing interest rates, which usually attract foreign investments in Indian markets. Historically, whenever interest rates have eased up, foreign investors have looked for growth opportunities, and India usually becomes a prime candidate for all of it. With the Reserve Bank of India likely to join this easing trend next year, it could create a supportive environment for Indian stocks, provided inflation and other domestic factors do remain stable. Another major factor here is the resilience of retail investors in India. Look, in recent years, domestic inflows from Indian investors have been 5.5 times greater than those from foreign investors. This local support has helped Indian markets stand tall against global uncertainty better than some of its peers. But if domestic sentiment goes down, we could see this pillar of support weaken. So now the question is, what is really next for us? Look, as we head into the festive season, there is a lot of room for optimism. The potential for lower interest rates and steady retail participations offer a cushion. But that said, it is also time for some caution. Mid-cap and small-cap valuations are high and global uncertainties are not quite going away anytime soon. In the coming months, we are very likely to witness a balancing act where global challenges meet local strengths in India. Keeping a very close eye on all of it will be very essential for us as investors and people who track the markets to navigate through the road ahead in India's financial markets. Now let's move on to the final section of the day, which is a small news tidbits. First, Rajiv Thakkar sees fixed income as an appealing alternative to equities amid high valuations. He points out to private banks' long-term growth potential but limited short-term returns due to FPI outflows. Second, Maruti is ramping up utility vehicle production by 33% to meet consumer demand, which signals a strategic shift away from compact cars and aligning with broader market trends. Third, October's GST collections reached 1,87,000 crores, which reflected a 9% growth as well as economic resilience. This trend may support further government infrastructure investment and confidence in growth. Fourth and the final one, India's global share in exports like petroleum, gemstones, and sugar has surged, solidifying its position in key markets and highlighting its expanding export powers. That's all the news and stories I have for you today. I hope you found value in today's episode. Please share your thoughts in the comment section below because we would love to hear from what you feel. I'll see you tomorrow. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.